You're checking your bank account one morning and notice an unexpected credit of rupees 2,500 with a dividend entry. Your first thought might be,
where did this come from? Did someone send me money by mistake?
You quickly open your broker's app. You own 500 shares of ABC company and they've just paid a dividend of rupees 5 per share. Simple math. 500 times rupees 5 equals rupees 2,500. But then you notice something odd. The stock price has dropped from rupees 200 to rupees 195, exactly the amount of the dividend. Your excitement turns to confusion. Did I actually make money? Or did the stock price just adjust down by the same amount? It feels like the company gave you cash with one hand and reduced your stock value with the other. So what's the point? This is exactly how dividends work and why they often create confusion. In today's video, we'll cover what are dividends, why companies pay dividends, important dividend concepts and dates, how to select good dividend stocks, tax implication of dividends in India. So let's jump right in. Let's start with the basics. There are actually two major ways to make money from stocks. First, price appreciation, which means buying a stock at rupees 100 and selling it later at rupees 150. Second, dividends, regular payments companies make to shareholders from their profits. Think of it like owning a house. You can make money when the house value increases. That's like stock price appreciation. But you can also earn rental income every month. And that's exactly what dividends do. So here's how dividends work. When a company makes a profit, it has two main choices. Reinvest that money back into the business or share some of that profit with shareholders through dividends. For example, if you own 100 shares of a company that pays a rupees 5 dividend per share, you will receive rupees 500 directly into your bank account, usually every quarter or once a year. And the best part, you don't have to sell your shares to get this money. You get to keep ownership while getting paid. Now, what you do with your dividends depends on your investing goals. Some investors prefer to withdraw the money and treat it as a regular income stream, similar to rent from a property. Others choose to reinvest those dividends to buy more shares and potentially grow their holdings over time. In mutual funds, there's even a specific plan for this called IDCW, which is Income Distribution cum Capital Withdrawal. And under this option, dividends are distributed to investors instead of being reinvested. It's designed for those who want regular payouts instead of long-term compounding. So whether you prefer cash in hand or compounding returns, how you handle dividends should align with your investment approach. Now you might wonder, why would companies give away their profits instead of using that money to grow? Well, companies at different stages make different choices. You'll often find that newer, fast-growing companies may not pay dividends early on. And that's because they usually prefer to reinvest their profits into expanding the business, whether it's launching new products, entering new markets, or building technology. For investors in such companies, returns typically come through stock price appreciation rather than regular payouts. On the other hand, some mature companies like Coal India, ONGC, or Power Finance Corporation are known for paying regular dividends. Since they generate more cash than they need for growth, they often distribute the surplus to shareholders as dividends. Now, companies pay dividends for several important reasons. First, to attract investors looking for regular income. Imagine two similar companies. One pays dividends and one doesn't. Many investors, especially those looking for regular income, will choose the dividend-paying option. Second, to signal financial strength. Regular dividend payments send a message to the market. Our business is financially healthy enough to commit to sharing profits on a regular basis. Take TCS for example. They've not only paid dividends for years, but have steadily increased them, showing their confidence in future performance. Third, to reward loyal shareholders. If you stick with the company through good and bad times, dividends are a way for them to say thank you. Fourth, limited growth opportunities. Sometimes mature businesses may not have immediate plans for large-scale expansion. In such cases, instead of holding on to excess cash, they choose to reward shareholders through dividends. It's a way of sharing the company's ongoing success, especially when the core business continues to generate steady profits. So understanding why companies pay dividends is just the first step, but it's also important to know a few basic concepts and key timelines because they can really shape how your dividend investments work out. Let's start with dividend yield. This tells you how much you're earning relative to the stock's price. The formula is pretty simple. Annual dividend per share divided by stock price, then multiplied by 100%. So, for example, if a 500 rupee stock pays a 15 rupee annual dividend, the dividend yield is 3%. In India, most stable dividend paying companies have yields around 2 to 3%. But some sectors like utilities and PSUs can offer higher yields. Now, if you're wondering how to check the dividend per share of a stock you already own, it's super easy on the Kite app. Just follow these steps. Tap on your user ID, scroll down and tap on Portfolio, then scroll again and tap on the stock you want to check. Finally, tap on View Dividends to see the dividend history. It's a really handy way to track how much income your investments are generating and also spot patterns over time. Next, let's talk about the dividend payout ratio. This shows what percentage of the company's profit is being paid out as dividends. And here's the formula. Total dividends divided by net income, then multiplied by 100%. A payout ratio between 30% to 60% is often seen as balanced. It suggests that the company is sharing profits with investors while still reinvesting in growth. But this can vary a lot across sectors. Some capital-light or stable industries might have much higher payout ratios and still be financially healthy. Now, one of the most important factors, consistency. Has the company paid dividends regularly for years? Even better, has it increased dividends over time? Take companies like Hindustan Unilever. They've been steadily increasing dividends for years. A long history of dividend payments usually means the company values shareholder returns and has a sustainable business model. And yes, this history is also available on the Kite app. Now coming to important dividend dates. When you're investing for dividends, there are a few key dates you need to understand. Number 1, declaration date. This is when the company officially announces the dividend. It's like a formal invite from the board saying, we're paying this much per share on this date. Number 2, record date. This is the date when the company checks its shareholder records to see who's eligible to receive the dividend. Think of it as the company literally looking at its books to make a list of eligible shareholders. Number 3, ex-dividend date. This usually falls on the same day or one trading day before the record date, depending on trading holidays. If you buy the stock on or after this date, you won't receive the upcoming dividend. It's called ex-dividend because the stock starts trading without or ex the dividend entitlement. Here's a simple way to remember it. Think of it like catching a train. The record date is when the company checks who's already on the train. To make sure you're on it, you need to have bought your ticket, that is the stock, before the ex-dividend date, because the system takes a day to update your name in the passenger list. And finally, the payment date. The payment may take a few days or even weeks after the record date, depending on the company's schedule. Now that you understand the concepts, let's talk about how to find good dividend-paying companies. So look for companies whose business models you understand, like consumer goods firms, banks, or utilities. When you understand how a company earns and manages its cash flows, you're in a better position to judge whether its dividends are sustainable. For example, stable businesses with consistent earnings are more likely to maintain or grow their dividend payouts over time. Check their dividend track record. Has the company been paying dividends consistently? Companies with a long history of regular payments are generally more reliable. Keep an eye on very high yields. If a company is offering a dividend yield much higher than others in its sector, it's worth taking a closer look to understand the reason behind it. Now let's assume you've created a portfolio of dividend-paying stocks and have just started receiving dividends from them. Now the most important part, taxes. In India, dividends are taxed as income, meaning they are added to your total taxable income and taxed at your personal income tax rate. If your total dividend income exceeds Rs 10,000 in a financial year, the company will deduct a 10% tax deducted at source or TDS before paying you. And this TDS is adjustable against your final tax liability when you file your income tax return. The tax treatment varies depending on your residency status and investor type. Now, it's important to note that dividends are taxed in the year they are declared, distributed, or paid by the company, whichever event happens first. So if a company declares a dividend in March but pays it in April, the dividend income is taxable in the financial year ending in March. To ensure you're maximizing your returns and staying compliant, it's always a good idea to check the latest tax rules or consult with a tax advisor. So there you have it. Dividends are a great way to earn passive income from your investments without selling your shares. Initially, getting a dividend can feel like free money until you see the stock price drop by the same amount. But don't worry, that's exactly how it works. You're not losing value. It's just that part of your investment that's been paid out to you in cash. And just remember these tips before investing in dividend-based stocks. Look for financially stable companies with a history of paying consistent dividends. Focus on sustainability rather than just chasing the highest yields. Understand the important dates, especially the ex-dividend date. Choose what to do with your dividends based on your goals, whether it's using them for regular income or reinvesting to grow your own portfolio. If you're interested in learning more about this topic, visit this Varsity module to learn more about corporate actions and their impact on stock prices. The link is in the description. The more you learn about these basics, the better an investor you can become. You can easily open a trading and demat account with Zerodha entirely online if your phone number is linked with Aadhaar. Just click the link in the description and follow the simple on-screen instructions. If you have any queries about stock dividends, feel free to leave a comment below. We'll be happy to answer them.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Brokerage will not exceed SEBI prescribed limits.